A life insurance agent will almost always steer you toward the expensive policy because it pays them up to 10 times more. That's not a conspiracy. It's just how the commissions are built. And it matters because term and whole life cost wildly different amounts for the exact same death benefit. And picking wrong can quietly drain hundreds of dollars a month for decades. The good news is that the choice is actually simple once you can see what's really going on underneath the sales pitch. So here's how to know which one you actually need. Let's start with what each one even is, because the whole decision hinges on this. Both policies do the same core thing. They pay your family a tax-free death benefit if you die. That's the entire job of life insurance. If someone depends on your income, this is the money that keeps them afloat when you're gone. Term insurance covers you for a set window, say 20 years, and then it ends. You pay your premium, you're protected for that stretch, and when the term is up, the coverage simply stops. Whole life is different. It's a type of permanent insurance, which means it never expires. And on top of the death benefit, it builds a savings bucket called cash value. That second job, the savings account bolted onto your insurance, is exactly why whole life costs so much more. So here's the reframe that makes everything click. Term is pure protection. Whole life is protection bolted to a slow-growing investment account that you pay a premium to access. Same death benefit on top. But one of them is carrying a second, expensive job underneath. And that distinction explains almost everything that follows. The reason people buy life insurance in the first place is to cover a temporary problem. The years when your family would be wrecked financially if your paycheck disappeared. Once the kids are grown, the mortgage is paid, and you've built up savings of your own. That need usually fades. Term is built to match that shape. Heavy protection during the risky years, then it gracefully ends when you no longer need it. Whole life, by contrast, charges you forever for a need that, for most people, doesn't last forever. Now let's talk about what that second job actually costs, because the price gap is enormous. Picture the same person buying the same coverage. A healthy 35-year-old wants a $500,000 death benefit. With a 20-year term policy, that runs roughly $30 a month. Cheap, about the price of a streaming bundle. Now take that identical $500,000 in coverage and buy it as whole life instead. The price jumps to around $500 a month. Same person, same payout to the family, but easily about 15 times more expensive. Sit with that for a second because it's the whole ball game. That is not a rounding error. It's a $470 a month decision, every single month for decades. Get this one choice wrong, and you've committed yourself to a payment most people never stop to question. So where does all that extra money actually go? Because most people assume it's quietly piling up in their cash value. It isn't. In the early years, a large chunk of your premium never reaches your cash value at all. Often, 50 to 80% of your first-year premium goes straight to commissions and fees. That's the agent's payday. And it's exactly why an agent's incentives lean so hard towards selling you whole life in the first place. The expensive policy pays them. The cheap one barely does. After those fees take their cut, the cash value does start to grow. But slowly, usually somewhere around 2 to 3% a year. And because so much was skimmed off early, it typically takes 10 to 15 years just to break even on what you've paid in. Until then, you're effectively underwater. That creates a trap most people don't see coming. If you quit the policy before that break-even point, and a lot of people do, you can walk away with less than you put in. You paid for years and you still come out behind, and lapse rates are higher than the sales pitch admits. Life changes. You lose a job. Money gets tight. The $500 payment becomes the obvious thing to cut. The very people who were sold whole life as forced savings are often the ones most likely to drop it early, right when the fee drag has done its most damage, and the cash value has barely started to grow. The product is designed to reward the few who hold it for decades, and quietly penalize everyone who can't. Here's the strategy that beats whole life for most people. It even has a name: buy term and invest the difference. The logic is clean. You buy the cheap term policy for $30 a month. Same $500,000 in protection. Then you take the roughly $470 monthly difference you just saved, and instead of handing it to an insurer, you invest it yourself in a low-cost index fund. Now watch what that difference does over time. At a historical-style 7% average return, invested every month for 30 years, that $470 a month can grow to roughly $590,000. Compare that to a whole life cash value of around $180,000 for the same total outlay. It's not close. The money you control invested cheaply lands far ahead of the money the insurer manages for you. But there's a catch you have to respect because it's where this strategy lives or dies. You have to actually invest the difference, automatically every month, without fail. If that $470 quietly leaks into nicer dinners and bigger car payments, the whole math collapses. And then the forced savings of whole life starts to look smart by comparison. The strategy is only as good as your discipline. Before you decide, there are two things people almost always miss, and a handful of rare cases where whole life genuinely wins. First catch. With a standard whole life policy, when you die, your family gets the death benefit, and the insurer keeps the cash value. You don't get both. Read that again because it surprises almost everyone. You spent decades building that savings bucket, and at the moment it's supposed to matter, it doesn't come to your family. The death benefit pays out. The cash value stays with the company. Second catch, and this one's on term. Term can expire while you still have dependents. If your coverage ends at 55 but you've got a kid in college and 10 years left on the mortgage, you're suddenly exposed. And rebuying coverage later is far more expensive because you're older and possibly less healthy. So protect yourself two ways. Choose a length that actually covers your kids and your mortgage, and pick a convertible policy. One that lets you switch to permanent coverage later without a new medical exam. Now, the exceptions, because whole life isn't useless. It just fits a narrow few. It can genuinely make sense for estate tax planning on very large estates, where the 2026 exemption sits around $15 million for a single person and around $30 million per couple. It can make sense for funding a special needs trust, where you need money to be there no matter when you die. And it can fit a permanent business need, like a buy-sell agreement. But for the other 90+% of people, term wins, and it isn't close. So let's pull it all together. Both policies pay a tax-free death benefit. That's the shared job. Term is temporary and cheap, whole life is permanent, and builds cash value, but it costs about 15 times more for the exact same coverage. And that extra premium doesn't quietly enrich you. It gets eaten by big early fees and then grows slowly, around 2 to 3%. Which is why, for most people, buying term and investing the roughly $470 monthly difference at about 7% can leave you with far more, something like $590,000 versus $180,000 over 30 years, if you actually invest it. Remember the two catches. A standard whole life policy pays only the death benefit when you die. The cash value stays with the insurer. And with term, pick a length that covers your real obligations, and make it convertible so you keep your options open. Whole life genuinely fits a narrow few. Large estates, special needs trusts, permanent business needs. For almost everyone else, term plus investing wins. The expensive policy is the one the agent wants to sell. The right one is usually the cheap one you almost overlooked. If this made insurance feel less like a sales trap and more like a decision you can actually make, hit subscribe. That's exactly what this channel is for. The money stuff nobody ever sat you down to explain. And here's the thing. Insurance protects you against catastrophe, but most of life's surprises are smaller than that, and they hit a lot sooner. So before you ever need a death benefit, you need a buffer for the flat tire and the broken furnace. Next up, watch video 6, how big your emergency fund should actually be. I'll see you there.